best time to buy real estate when there's blood in the streets, even if it's your own blood. This is a buying opportunity for those that are ready. But unfortunately, it is also the possibility that some deals just won't make it.
In this episode, I talk with Trevor Thompson. Trevor is an experienced business operator who opened 45 iFly indoor skydiving locations. He's now an active multifamily investment sponsor and asset manager. We discuss his experience in corporate America and how that's helping him in real estate. We talk about the current state of the real estate market and his advice for folks that want to invest in multifamily, but they think they need to start in single family first. I hope you enjoy. Now on to the show. How's it going, Trevor?
Going great. Happy to be here. Thanks for having me.
Absolutely. Thanks for coming on. I've seen you, we talked about this a little bit before. I've seen you all over social media, and it was good to catch up with you a few weeks ago, and glad to have you on the podcast. So, you're a little unique in the previous podcast guest that I've had, because you haven't spent your whole life in real estate. You actually you've got a lot of success in the corporate world. Can you share a little bit about that?
Yeah, so I have the world's most unique background. In fact, I did a YouTube video, Am I the World's Most Interesting Man, just because I got such a strange life. Yeah. So I actually I'm from Canada, Niagara Falls, and I actually started at age 13 working for Ripley's, believe it or not. I did 5 years with them, and then I went to Guinness World of Records, and I did 18 years with them and managed their rights in North America, and did like some amazing things, like met Michael Jackson when we gave him a Lifetime Achievement Award, had the world's tallest woman actually working for me. And then I was going to open a Guinness in Orlando, but then Ripley's, oddly enough, that I used to work for, bought the rights out and wouldn't give me a franchise. So oddly enough, I opened this haunted house, and I was there for 3 years, and it was scary. We didn't make much money, but I'd kind of committed to the guy who put the money up I would stay there. And then I got recruited by a company called iFly Indoor Skydiving, and I did over 20 years with them. And so when I first started out, the business was losing money, and we basically built it up to multi-million-dollar business. I opened 46 of 80 locations around the world, held various positions within the company, and then unfortunately at COVID, I ended up getting let go. Makes sense. I was in the development side. They were just trying to stay alive. And interesting part of that is actually the very first team meeting. So like 25 years ago, I was given a copy of Rich Dad, Poor Dad. And I read it and I went, wow, that's amazing. And I did, unfortunately, what too many people did. I put it back on the shelf and I just kept working. I loved my job. I loved what I did. I knew I should do something in real estate, but never did, and just kept working. I was like everyone else, afraid of toilets, tenants, and trash. I didn't understand it. And then luckily, iFly got bought out, so I got a payday. So I went from toilets, tenants, and trash for a while. I had no time, no money. And I had the no money excuse was kind of gone. And so I started looking into real estate again. And I went to several of those weekend webinars, and in-person ones, and finally stumbled across multifamily syndication. And it was like a light bulb came on, because that's what I've been doing my whole business career, taking businesses that weren't doing well, putting some CapEx, putting in some things, and then selling them for a multiple of your improvement. And I went, how did I not see this? How did I not understand this? And then the rest is history. In 5 years, I've passively invested in 20 deals. I'm on the active side now on my 4th deal right now. So I've just dove right in, and I'm on a mission to make sure that nobody waits to buy real estate. So I always say, don't wait to buy real estate and wait, because I didn't start till my late 50s. And if I had started in my 20s, my financial situation would be a lot different. Real estate is a time game.
It really is. And I tell folks, I was like this in my 20s. I read Rich Dad Poor Dad in my 20s. Or actually, I think I was 9, but I was probably 20. And I'm so eager, and I'm a high D, I'm a driver, I'm an entrepreneur, so I'm like, go. But I tell younger folks, like, look, you can be patient, because look around the room. A lot of folks here are doing pretty well, but they're also in their upper 40s, 50s, or even people in their 60s, and they're getting their first few deals. Like, you've got a lot of time, and it
Yeah,
doesn't take much. You can go out and do the multifamily game, and that's very lucrative. Or you could do the single family game and just buy one house a year and just
yeah.
amplify that over years, and just let time do its thing.
Yeah, and time combined with all of the other benefits of real estate investing, right? So the tax benefits, the depreciation benefits, all of the things. So if you think about this, if you're 30 years old and you put $100,000 into a deal and it doubles in 5 years, that's 200,000. And it doubles in 5 years, that's 400,000. And it doubles in 5 years, that's 800,000. And it doubles in 5 years, that's 1.6 million. And it doubles in 5 years, that's 3.2 million. So think about this. All you did was continually reinvest, right? You didn't take the proceeds, you didn't live off of anything. Just think of the power of that. And if you could do that several times, um, your world would be completely different, right? Everything would just, but people don't think of it that way, right? They just don't. They don't get it.
Yeah,
And
and it doesn't even
society
have to
teaches
double
us.
in 5 years. I mean, it definitely can, but it doesn't have to have a long-term
Oh
massive
yeah.
impact on your financial situation whenever you do just decide to retire or wind down, or maybe just take a big shift in priorities. So um, how did your experience operating in corporate America and iFly and the other ventures that you had, how did that experience carry over into real estate with what you're doing now?
Yeah, so oddly, quite a bit. Because I mentioned earlier in the podcast, so I opened new businesses, but we also took over existing franchises. And these existing franchises, I call them ma and pa run or small company run. They didn't have the systems and all of the processes, they didn't have enough capital. And so we would come in and buy one. We would spend some money fixing it up. We would spend some money improving the systems. We would spend some money training the management team, and then, of course, when they eventually all sold, they're a multiple of their value, right? So in the business world, we called it EBITDA, which is earnings before depreciation, interest, and taxes. In the real estate world, we called it NOI, but it sells for a multiple of that. And so I did that over and over again. We didn't always sell them; they did the one big sale. But increasing the value of a business is when you can increase their EBITDA 30% in a year, that's significant when it
Yeah.
sells them at a multiple. And we did that several times. And then another thing that was oddly similar is it's a very customer focused business I was in. And apartments and multifamily, especially, not all real estate is, but if you do it right, it's very customer focused, right? So you've got teams of people working for you. And at the end of the day, I used to offer the freedom of flight at iFly, but at the end of the day, now I just offer a better place to live with a management company that cares about them, improving their properties, making them safer and nicer. So all of those customer service skills translate really well. And just running teams and running businesses. And again, in the business world, incremental improvement is powerful. In the multifamily and real estate space, incremental improvement is really powerful, right? If you can consistently get more income and control expenses, it's a powerful combination.
Did you jump straight into multifamily, or
So my first passive investments were all multifamily.
okay, so you
And then
haven't bought any single family?
I've never bought a single family other than the houses I live in. Never. I shouldn't say that. I was once invested in a single family fund. So they syndicated a deal. But unfortunately, with COVID and then the rapid increase of value of houses, the model was broke, right? So, their goal was buy a house with a 200,000 ARV at a 1% rule. Well, that all went out the window and real estate in Texas, quadrupled in value. So that funds, but that was the only thing I did in that space was I put some money into a syndication for that. And it was one of my more, it gave me a 5% cash on cash at the end. And I think if their buy box didn't break, it would have been a much better thing. But it's a numbers game on the single family side, right? Buy it for X, lease it for Y, and that's how it works.
And then multiply that times hundreds.
Yeah.
there's a single family house, $200 a month, that doesn't really do a lot. It's mainly it's a long-term play.
Yeah, but I've never met anybody in the single family space that now is in the multifamily space that says, "Oh, I wish I would go back to the single family space." Right? Nobody. I mean, I've got two friends, and they never heard of multifamily, and they connected with me at a meetup about a year ago and said, "We heard about this multifamily thing. We want to learn about it." And they owned and self-managed 116 homes, and the biggest they had was an eightplex. And it was a lot. They still do. They still have them. There's still some of them they're moving away, but there's economies in scale, right? And it grows you quicker and it reduces your risk, right? If you have 100 apartments and you have 10 vacant, which is a lot, you're still 90% occupied, right? If you have 10 homes, and you've got, it really can't hurt. So there's a lot of economies of scales in the multifamily. And I've invested in other asset classes as well, just because I wanted to be a little more diversified than having everything in multifamily with, the number of syndications I've done.
Yeah, and there's pros and cons to both. I'm like you, or I still have single family rentals. I'm slowly getting rid of them and transferring those into our fund, which is really focused on multifamily right now. But there's definitely pros and cons to both. A lot of folks do feel like single family, it's the required step into multifamily. And I'm like, no, you don't have to do that. You can.
Yeah.
There's skills you're going to, I mean, you have gained valuable skills in the corporate world and brought it into real estate. There's obviously skills you can bring from single family and bring it into multifamily, but it's not required. You can get those skills elsewhere. You can work for companies. But for those that multifamily, that is where they want to be, but they feel like they have to go the single family route. Any advice there?
Yeah. So, if I was, again, to go into the multifamily space, at some point, you either have to have a network of people you can raise a lot of money from, or you need to have some money yourself. So I started out, I got a payday when the company got bought out. So, I had money, so I was able to invest. If I was starting as the brand new young person and I was 18 again, I'd start out, the bigger pockets. I'd be starting out with house hacking, and I'd be starting out with, I'd buy a duplex, then I'd buy a fourplex. But I would hope that I would get to the epiphany of multifamily a little bit sooner. But it's a great way for someone to start, and starting is the most important part of this, right? And then continuing and then doing the best you can to maximize time for value. On the single family space, it's a lot of time, right? And you still have to put time and energy into it, unless you hire management companies. But the margins are so low that they tend to eat up a lot of the profits. So you're only getting the appreciation gain, which is still substantial, but it's just a little more risky when you do it. But again, I don't say not do it. I just say do it, get your base, build up some of your net worth, build up some of your skill set. And, instead of getting 100 homes, go from that duplex to a fourplex to an eightplex to a 16plex to a 32plex. Think of the math that way. And then once you start amassing those things, then you'll connect with partners, because you can do a lot of that on your own or with a small group of friends. And then syndication is a team sport. So at some point now you need a team, you need partners, and then you can go ahead and utilize those partnerships to get into the bigger space.
Yeah, in the team sport, that really plays into how it would be difficult to jump with no skills or experience directly into multifamily, just because at some point you have to add some value. So if you have cash, that's value.
Yeah.
If you have a good balance sheet, that's value. If you've got good construction management, project management, asset management, that's value. But if you don't have any of those things, it's difficult unless, and this is the one thing that a new investor could do, it's going to be challenging, but you could do it, and that's get the deal. Yes. Now, you're probably not going to go have brokers of 200 plus units really entertain you if you don't have any experience. It's just going to be difficult to get in that door. But smaller multifamily, the 10, 20, 30 unit, anything sub 50, you probably could.
Yeah, you
And
definitely can, and you can definitely like I'm fortunate and unfortunate at the same time. So I live in Austin, Texas, right? One of the hottest markets in America. So that's great because there's lots of activity, there's lots of value. But if I lived in Wichita, Kansas, it's a smaller market. So I would have stood a better chance of finding that mom and pop operator just because big operators aren't drawn to smaller markets as much. And so, again, real estate in your neighborhood is the easiest thing to start with, but it doesn't always make sense, right? If you live in Los Angeles, this statement, or San Francisco, that's a super challenge. Do people still do it? Absolutely. And are they successful? Absolutely. It's a tougher mountain.
definitely. Well, what are your thoughts on the current state of the market?
Yeah, so clearly we went through this craziness, I'm going to call it. And a lot of people, so interest rates were at an all-time low, like insanely low,
Yeah.
right? 2-3% loans were kind of normal, right? And which is insane, right? Because the average is more in, the 4, 5, 6 range. So what happened is in such a short period of time, the shortest period of time in the history of the world or America, we went from here to there, right? We went to 7, 8, 9%. And so it just shocked the system, dramatically shocked the system. I'm not much of an economist, but unfortunately hasn't done a lot yet to curb inflation. It's sort of slowed down, took a bit of the heat off of it. So that's been super traumatic. And those things are going to, though, there's several quotes, right? The best time to buy real estate when there's blood in the streets, even if it's your own blood. This is a buying opportunity for those that are ready, but unfortunately, it is also the possibility that some deals just won't make it. And they won't make it because they didn't raise enough money, they didn't have enough money, they don't have enough reserves to cover this spread, right? So the property's still profitable, but you don't have enough money to cover the spread. And that's what's really challenging about this time.
You mean by spread, like as far as the refinancing?
That's correct, right? So now all of a sudden, because the interest rate goes below the NOI line, so you may be operating at a profit, but I'm a passive on a deal right now, and its interest rate, payments went from 18,000 to 36,000. Substantial monthly difference, like substantial, because they didn't do a very good job protecting it with a cap rate and things, and makes a big difference. And so now they're struggling, but they'll still catch up, right? They're still above water. They just got to be super careful.
Yeah. So buying rate caps, very, very common, very smart to do with floating and rate debt, which a lot of the whole bridge. A lot of operators over the last few years have been operating under the kind of like the Burr model. It's just been over a longer period of time, like a 3-5 year period of time. And the market's definitely given a lot of tailwind to that. But buying rate caps and not quite stress testing it, and how likely is it that mortgage rates are going to triple over a 12-month period?
It's
Unlikely, but
insane,
it
right?
happened.
Absolutely insane. I'm on a couple of deals right now where they did buy a rate cap, but they didn't have enough reserves to cover all of it.
Yeah.
And the payment difference, and big shock to the operating system.
Mm-hmm.
Because again, you kind of bought it and never thought you'd need it. You just bought it, so you had, oh, we bought it, we're safe. But if you didn't have enough reserves, and again, this crazy how fast things increased in value made people get less conservative, right? In theory, anybody could make money in real estate during the last so many years just because it was so hot and heated up. And so a lot of people did lose their core principles of, good cash reserves, good stress testing, making sure you're ready, because the rise of the market bailed them out every time.
Yeah, yeah. And that's why I've been cautious as a fund manager, focusing on operator experience. So,
Yeah.
I mean, there's a lot of operators that I know have gotten, and they've done pretty well over the last 3 or 5 years. But it really, if you've been in the industry for the last 10 years, by and large, you really don't know a rainy day. It's been a strong market, and the last 2 to 3 have been ridiculously strong.
Yes.
So anyone in that, they haven't really been tried through a deep downturn.
Yeah.
And I'm not saying what we're going through is a deep downturn, but it is
Yeah.
turbulent.
Yeah.
And
Well,
there's cloudy skies. We don't know what's ahead.
yeah,
So
Warren Buffett says you don't know who's swimming naked till the tide goes out.
exactly. So I mean, we focused on like the first multifamily we did in Daytona Beach. You know, the primary operator had 40 years of experience. It was and $1 billion assets under management and 1,000 units locally. So it was a few boxes checked to show them they had the operational experience. Any company that's been able to survive 40 years, that doesn't mean they're guaranteed to survive forever. But they've definitely seen a few things and they've got the experience to navigate, cloudy skies. So, and the same thing we were doing with Class A in San Antonio, very similar situation, 40 years of experience. Also institutional partners like JP Morgan on board, just checks a few of those boxes.
Yeah.
How do you approach? So you've been on LP and you're probably still on LP. You're also on GP. For those that don't know, LP typically limited partner, but usually it's basically just a certain class of investors that has limited liability in the asset. Basically, they're by and large the worst they could lose is their investment. And then there's GP, the general partner. They're the ones running the show, the operator. So you've been on both sides of that.
That's correct. Yeah.
Going forward for investors now, how are you, and also working with investors, the feedback you're getting on new opportunities? What's the sentiment there?
So I mean, deals that are coming across my desk to invest in aren't near as good as they used to be, right? And when they are, to be honest, I just delete them. Somebody who's offering me at 2.8x on my money. Yeah, sorry. Hit the delete button. Don't even, try
even
to
if that's true, you got to tamp down it on paper because no one will believe it.
Yeah. And so at this point in time, who you know, like, and trust is getting more and more important. Right? Because anybody could, in theory, kind of make money. Well, now the good people are going to make money. The people that are down, being able to double down. And for me, starting out on this switch, it was super challenging. I went months and months and months putting offers on deals and coming nowhere close. And then as things started to get a little fuzzy, I started coming second and third. And, to be honest, a couple of them we ended up losing, and sort of glad we did, because it was even shorter term bridge debt, like 18 months. And we would have been hurt. So I'm so glad we got out. And then, to be honest, my first GP deal, which again, this is, a lot of people don't understand this, right? On the active side, there are rewards, but there are also risks. And we spent 6 months of our lives working on a deal, and we're unable to finish it and close it. And as a group of GPs, we lost $350,000. 75 was mine, because there's at-risk money. And this was a loan assumption, which is getting more and more normal. But this was when it wasn't that normal. We had a pref equity in the middle, and we could just never satisfy the lender with the terms of the pref equity. Even rewriting the agreement 3 times over the 6 months, we just couldn't get it approved. And part of it was, we were a newer team. We didn't have the experience. And so there's a lot of risk letting you come in and do that.
100%. Going back, how long was that recent, or?
So that was almost 2 years ago now.
Okay. Going back. So this is a lesson for folks. How would you approach that situation today to put yourself in a better position to win?
I would have had stronger partners. So, okay. At the end, I was just trying to get on a team. I was trying to win a deal, and I don't think I got reckless, but I certainly somebody with a little more, this was the biggest deal they'd done as well. And by far, the biggest deal that I ever thought I could get in on, one of my first deals. And again, it was a great property. And if we could have got it done, it would have been a home run. I want to make sure everybody's clear too. Investors were all returned all of their money. So no passive investors lost money. It was only the sponsors that lost the money. And it was interesting because I said, well, I'll never do a loan assumption again after losing this money. And the next deal I closed was a loan assumption.
Yeah, because it's not the loan assumption. There's other factors at play.
It was the spread and the fact that we needed this third-party pref equity to make it work. And that's another thing too, when you need something to make it work, sometimes maybe that is an indicator, that it's not like ideal. When you say, okay, without this, I can't make this work.
Yeah.
And when you have one thing that can sink the whole ship, so again, on our loan assumption, we were buying an underperforming property. So we had to convince the lender that we were better operators and could do it. And we did get approved, and we are doing it. And, we've taken care of everything. We're turning the property around. But, so it was funny. I said I'd never do it. And then my, next two deals had it in it, and it is what it is.
Yeah. I mean, that's what we're doing with the San Antonio deal we're doing now. But going back to the operators, I made that mistake early on in 2013. Very first multifamily, it was 29 unit, 27 unit, in rough shape. It was like a D. And I thought I did all my due diligence. I made sure I could refi out. So we took out hard money, put in like 150, 170 grand, and went to go refi. And then they were like, no. Because I mean, I didn't know the questions. I didn't know what I didn't know. So what I thought was good enough up front, it turns out, that was just really 101. I should have dug a little bit deeper. And at the end of the day, 2013, commercial capital was pretty tight. And like you probably experienced on your side, like I didn't have operational experience to make the lenders comfortable, even though I had single family experience. So we sold it thankfully and made money. But the guy we sold it to, like my pro forma or my projections played out. So I was right on the acquisition. I was just wrong on the way implemented it. Should have brought in a partner. And the funny part to that story is the hard money lender. I was telling him a joke because I'm friends with him, the owner, and I told him about it after we sold it, and he goes, "Well, you should have just asked me. I would have partnered with you on it." Like, oh man. So that was my fault for trying to go lone gunman.
Yeah.
So
it's definitely, and I want to say one thing too. One of my best investments to date were with a sponsor that I went to a webinar where they talked about a deal that everything went wrong. They were honest about it. They managed to save everybody and nobody lost money. And I actually was super impressed with their honesty, and invested in them, and 3x my money in 20 months.
It's funny. There's a certain level of comfort that comes with someone who has a humility, because if you're not that humble, it generally means, well, I don't know, generally that may not be fair, but I'm going to say my thought is you're hiding something.
Yes. Yeah.
And if you are humble, then you're okay, because you're very comfortable with where you are and where you're going.
Yeah.
And you're okay with the feedback on that. And I think
and
people
at the
relate
end
to
of
that.
the day, right? You learn more from your mistakes than you do from your wins.
Always.
I just hope that on your mistakes, someone else doesn't get hurt, right? That someone else lose money, or you figure out a way to make it all right.
100%.
And that's super important, to people that, and because we all look good on the internet, right? I look great on the internet, but at the end of the day, a lot of people say, why do you talk about all this stuff? I says, I want to be real. I want people to understand, and I still 100% into real estate investing. Just make sure you get educated and you know what you're doing.
Love it. Couple questions we ask every guest that comes on as we close out here. If you could give advice to your 20-year-old self, what would that be?
Yeah, so don't wait to buy real estate and wait. That one's an easy one.
I thought you would go there. What book or books have greatly influenced your life?
Yeah, so obviously we talked about Robert Kiyosaki, and Rich Dad Poor Dad is a big influencer, but I would say the biggest life changer, and you got to do it on Audible, is Grant Cardone's 10X. And then you've got to listen to Be Obsessed or Be Average, also on Audible, because it's really the explanation of 10X. And I got to tell you that was life changing. Like literally sat in a hotel parking lot waiting for the chapter to finish, and then put my headsets on to listen to the next one. It was very powerful.
Do you like the Audible just because you get Grant's direct to your face street
Love
talk?
him or hate him. And, I would never join his real estate mentoring program, any of these things, but man, Audible, and I know he's tough. A lot of people don't like him. And I just say, listen to it. I used to work for a guy that said even a broken clock tells the right time twice a day. So you're gonna find something in there, right? And just listen to it, but audible, because he does so much. He brings it to life.
Yeah, no, I've actually listened to both of those on Audible. I don't own the physical ones, both of them on Audible, and yeah, they're great.
Yeah.
In the last 5 years, what new belief, behavior, or habit has most improved your life?
Yeah, so I think implementing the 10x mentality, just getting out there. We mentioned before the call started, oh, I see you everywhere, and I literally at the end of 2019, or sorry, the end of 19, thought, how am I going to change my life? And I listened to one of his podcasts about being omnipresent. And if people don't know who you are, it's your fault.
Yep.
And so I just ramped up my efforts to have people know who I am. And the first time it paid off, I went to Jake and Gino's, and I was in the elevator. Some guy I didn't even recognize went, "You're Trevor Thompson. Can we do a selfie?" And it was like, oh, I made it. I don't even know this guy. And in the elevator, when I first check in, somebody wants a selfie with me. Again, be careful. We all look good on the internet, but it was a big new curve for me, just to put, because I'm actually an introvert. A lot of people don't realize that, but just put myself out there and force myself to do it.
Yeah, and I'm an introvert too. I think it's important for those that are struggling with that advice is you don't have to be Grant, be you. You can you can be omnipresent, or you can be very visible on the various platforms that you enjoy, and still be you. You don't have to be Gary Vee. You don't have to be Grant. You don't have to be all these bigger than life folks. Just be you, bring it, and provide value.
And if you are that, a really good video, Simon Sinek has a video about the difference between extroverts and introverts, and he's one. And he says an extrovert wakes up with no coins, and every interaction gives them a coin. And the introvert wakes up with how many ever coins you have, depending where you are. So let's say 5, and after 5 interactions, you're out of coins. You need to go recharge. So when I go to conferences, I take an hour and I go recharge, and then I go back because I've got some new coins in there. Or he says when he speaks to an audience, he really looks at one person at a time and forgets there's thousands there. Interesting thought.
Yeah, I mean, Tim Ferriss, he's an introvert. I think he said before where when he does like a book signing or if he does an in-person thing, it takes him 3 days to recharge.
Yeah.
So what, how can people reach out to you?
So the easiest way is LinkedIn. So you got to remember the K Trevor Thompson. I'm on LinkedIn. And I'm also, I'm with Massive Capital now, so you can find me through the Massive Capital team. It was a new team that I've joined up, but LinkedIn is the quickest and easiest, and I have an Instagram. I'm still figuring out, old guy trying to do young guy stuff, and then I am on Facebook, but it's harder for me. I don't take as many invitations there as I do LinkedIn.
Love it. Love it. Well, thank you so much for coming on. I'm in the Houston market, so hopefully we can connect sometime soon.
Awesome, yeah.
Thanks for tuning in. If you got any value out of this at all, please like, comment, subscribe, follow. I'd love to hear from you. And for more real estate related content, market observations, upcoming events, you can go to investedx.com and subscribe to our weekly newsletter. I promise you won't regret it. Thanks again.